Howdy there, folks. Welcome into today's video. The stock market has two new major problems, and we're going to go over that in this video. I'm going to show you everything that's going on there. One of these problems is just a colossal problem that's a problem for us all. The second problem is actually, I think, in my opinion, kind of a blessing in disguise. If you're a long-term investor, actually, what's kind of going on there is the perfect scenario, essentially. And we'll dive into that. I'm going to show you the numbers, all the data, and everything that's going on there. So yeah, I hope you guys enjoy this video. As always, I appreciate you all joining me. Thank you for being subscribed to the channel. Okay, first off here, somebody in the private stock group shared this the other day, and I thought I would just show you guys this. This is insane. I think this is in Miami, if I recall, and this was in the 1950s. Look at this, $7,900 bought you a 3-bedroom, 1-bath with a screened porch. Oh, how about that? A screened porch, baby. Look at the monthly payments, less than $50 a month, and you get a brand new house built for you. Holy smokers. That ain't no dang jokers. You gotta be kidding me. You gotta be flipping my flapjacks, man. That's absolutely amazing, right? And nowadays, look at this house you get in LA, 900 square feet, $600,000. And this is amazing when you do the math on this, right? Basically, you can live in this house for 2 months, right? And in those 2 months, you would have been basically able to buy one of those entire homes. Like, think about that. The 2 months of mortgage payments on this, and you would have been able to own one of those homes back in the 50s just outright. Like, this is just crazy to think about, right? And I think the moral of this story is, one, prices of houses have appreciated greatly, right? But whatever prices you see today, in terms of the next 1 to 2 years, it could seem expensive, right? If you buy a house today or you buy into the stock market or whatever, right? Could seem high. But over a 5, 10, 15, 20, 30-year span, you start to realize, oh my gosh, we're getting the best deal ever. That's always the way it happens. And it's very hard for us to wrap our minds around that when we're in the moment, right? It's very hard for us to wrap our minds around if you're buying into the NASDAQ at 11,000 like it is today. That's actually a smoking deal. It's very hard for us to wrap our heads around the fact that if you go buy a new house, it's actually a smoking deal. And it's so hard for us to even get to that place mentally, right? Because we think of it as it's so expensive. But as time ticks on, you realize it's like a smoking deal. And there's going to be a day in the future when people look back and they're like, oh, those people that got to buy stocks when the NASDAQ was 11,000, so lucky. Those people that got to buy homes when the average price was only $400,000 or whatever, they're so lucky. It's just crazy. That's what happens over time. The dollar gets devalued. You have inflation. The economy grows. The GDP grows. People's wages go up. All those sorts of things happen over time. And as that happens, you realize, oh my gosh, we were getting the best deal ever. We just didn't realize it in that moment. And I'm sure back in the 50s, people looked at that house for almost $8,000 and thought that was crazy, right? And now we look at that and we're like, that's just such a joke. It's not even funny, right? That's what happens as time ticks on here. Okay, guys. So next up here. So this is very important. I wanted to show you guys this, okay? Man inside the private stock group shared this, okay? I thought this was really cool. It's a service called Trueflation. Basically, what they do is they run numbers on, they try to run the most accurate, up-to-date, inflation numbers that are true inflation numbers, right? And the government, if you always look at the government numbers, no one likes the government numbers, first off. I've never met one person in my life who's like, oh yeah, the government inflation numbers, those are right on. Those are perfectly correct. No, never, okay? And so the government numbers are very, very flawed. So it was cool kind of seeing the service and seeing where they have inflation at right now. They have it at 6 in terms of right now, right? And of course, the government numbers are always lags. They're always lags. They're always looking at a month, 2 months ago, right? And so they have us right now at an inflation number about 6.3%. Now, the interesting thing is this Trueflation had the true inflation rate actually substantially above the government numbers back a few months ago. They had it at 10 to 12%, back here, which is quite interesting. So if this is at 6%, then that would mean naturally the government numbers would be at 5%, maybe even 4%, somewhere in there. So we'll see what happens, but obviously it looks like inflation is starting to drop off a cliff. And I mean, that's what I'm pretty much seeing out there from almost everything versus where things were at back in the summer in terms of that rate of increase, right? Never mind that you have the comps year over year that are coming up that are really, really tough, okay? So Let's get into the problems. Problem number one. This is a major problem. Yield curve inversion reaches new extremes. Unusual relationship between Treasury yield reflect investors' bet on easing inflation and future rate cuts. That may sound exciting, but trust me, it's not, okay? Yields on longer-term U.S. Treasuries have fallen further below those of short-term bonds more than any time in decades. A sign that investors think the Federal Reserve is close to winning its inflation battle regardless of the cost of economic activity. A scenario in which short-term yields exceed long-term yields is known on Wall Street as an inverted yield curve and is often seen as a red flag of recession is looming, right? Last time we saw this was in a major way in terms of rate before a recession was actually in 2019. You saw this, and then obviously what happened in 2020. But some people look at that and they say, well, that was a recession caused by Rona, right? And so did the yield curve really see that? But you could also say, well, maybe we would have had a recession in 2020 regardless. And so you can go back and forth on all that, right? Yields on treasuries largely reflect investors' expectations for what short-term interest rates are set by the Fed will average over the life of the bond. Longer-term yields are generally higher than shorter-term yields because investors want to guard against the risk of an unexpected inflation or rate increases. At a basic level, an inverted yield curve means that investors are confident that short-term rates will be lower in the longer term than they will be in the near term. Okay. Typically, that is because the Fed will need to slash borrowing costs to revive a faltering economy, which makes sense. I mean, if we were to just imagine this for a moment, right? Imagine unemployment starts to climb massively in 2023. Imagine the economy starts to get nailed. Company earnings are tanking. Massive layoffs are coming. What do you think the Fed's going to do almost immediately? They're going to slash interest rates down to nothing, right? From there, the next step is the Fed's going to obviously start up the money printers, as they say, right? And they're going to do as much quantitative easing as possible. Whereas recently they've been doing quantitative tightening, they would move to a quantitative easing program in a very rapid fashion. So all that obviously makes sense, and it's not a great thing in terms of if you're feeling confident about the economy in 2023. The yield curve is more than just a little bent out of shape at the moment. Last week, the yield on the 10-year U.S. Treasury note dropped to 0.78 percentage point below that of the 2-year yield, the largest negative gap since late 1981. At the start of a recession that pushed unemployment even higher than it was, obviously, in the 2008 financial crisis. So, I mean, no bueno, okay? And I'm so sick of seeing, like, numbers that are back to where we were back in the 80s and stuff like that. And the inflation numbers have been back pretty much, in terms of the last time we saw inflation this high back in the early 80s. So, this is a very scary thing, right? And when you think about this, it's even scarier when you think about the fact that there's a record amount of homes being built in the United States of America right now. There's a record amount of apartments that are being built in the United States of America right now. So, I mean, there's a record amount of warehouse space being built in the United States of America right now. So, in my opinion, we're not going to need new homes, apartments, warehouse space, anything from the construction side for at least a few years. I think we're getting so massively overbuilt it's not even funny. And so all this stuff, all these projects are going to be finished up pretty much in 2023. And I think construction is going to be dead. I mean, dead for 2024 and 2025. And I think that's regardless probably what the Fed does now at this point in time. The more I look at it, we're getting so far overbuilt, it's not even funny. It's not even funny. It's scary, downright scary, okay? So that's problem number one we have to deal with, okay? Problem number two is good old Apple. This stock has now fallen about 7% roughly in just the past few trading days now at this point in time, okay? And this is a major problem for the market in the short term. It might be a blessing in disguise for investors for long term, and I'll explain that here, okay? So I just put out all the issues that are working against Apple over the next 6 to 12 months, okay? One is they had a record 2022. So they're going to have these insane comps to comp against. Here's the deal. Apple had obviously a great year in 2020. They had a great year in 2021. They had an even greater year last year. It would have been better if Apple actually kind of drop the ball a little bit in 2022, but they kept putting up record after record after record, right? And now they're going to have to comp against these ridiculous comps year over year, right? In an environment where the consumer is likely going to be extremely weak in 2023, where business spending is likely going to be down. And I'm talking from the small business side and the large business side. Because basically what you had happen, okay, and I think this is very important for every single person watching this video right now to understand this, okay? On the consumer side, just an average person, right? Folks were flush with money, flush with stimulus money over the past few years, and all those sorts of things, right? They had a lot of savings around it. So people bought iPhones and iPads and Macs, and everybody was at home, and they bought all that stuff like crazy. And so Apple went through this kind of like super cycle of spending around Apple products. Then on top of that, on the business side, big businesses were spending like crazy. I mean, yeah, let's get the whole new workforce a bunch of new MacBooks or this or that, right? And then small businesses have been feeling great, or were feeling great up until very recently, right? So they were buying new computers and all this stuff. And now you're going into an environment where the consumer is not going to be in a good place in 2023. Simultaneously, businesses, small businesses and large businesses, are going to watch every dollar spent. They're in contraction now at this point in time rather than expansion mode. So they're not going to upgrade a lot of the computer systems and things like that unless they absolutely have to. And so that creates a dynamic for Apple that I just think it's going to be very, very negative, right? And, I know I've talked a lot negatively about Apple over the last few months, right? And I'm not some Apple short seller, but I know this company inside and out. I used to own this company, and I've owned or own currently several stocks that are semiconductor companies into this company. So if there's one company I understand pretty well, it's Apple. And I'm just telling you, like the whole situation, it's not lining up good for Apple at all for the next year or so, okay, if not 2 years. They have massive production problems for the Pro lineup in China right now, and that's their one product. That's their one product other than the new Apple Watch that actually has like big demand right now, essentially, okay? So that's not good. They have huge demand problems for the regular iPhone 14s, huge demand problems. And so I think because they're having production issues, I think some people will buy the iPhone 14, so Apple's kind of lucky for that. But the problem is, iPhone 14, the average selling price of that ASP is much lower than for the Pro lineup. Much lower, several $100s lower. So that's something we're keeping in mind. So if somebody has to go buy a new iPhone, let's say for instance, right, and they're like, I'm not waiting on that Pro for whatever reason, right? So they buy they're like, oh, I'll just buy an iPhone regular 14. That's like $300 less they spent, right? So it's a lot less net income for the company, a lot less margin and revenue in general, right? Then they have an Elon problem now at this point in time. Elon, obviously, the number one thing trending on Twitter yesterday was Apple. Elon's causing definitely some brand damage to Apple because he's talking about they're not supporting free speech. There's a thing that basically with the whole China protests and whatnot, there was something about Apple wasn't allowing people in China to like airdrops or limiting their airdrops or something like that, which was very crazy, sketchy, and everybody's looking at that like, what are you up to here, Apple? So that's not a good look. So Apple has they're in like full scale, let's call it brand damage mode right now. Also at one of their production facilities, well, not where their iPhones are built essentially, but it's owned by Foxconn. There was some workers being beaten at one of those and massive like protests and fights and things like that. It's an ugly situation. And I even saw a video of like people literally running away and trying to jump over fences to get out of the facility because they're afraid they're going to be locked down. I mean, they're in full scale brand damage mode right now. And I'm sure their PR team's trying to work overtime on trying to figure out how do we handle this but not bring more attention to everything that's going on. And also Elon's bringing attention to the services business, which is that's a business where they basically collect 30% of all, money spent on their apps and things like that, right? So you have an app on iPhone, right? Somebody buys something on it, Apple collects their 30%. Now, that has been something that hasn't gotten enough government, in my opinion, scrutiny, and I think the more Elon brings this out, the more folks are talking about this, the more will have to be brought out. It is, Apple is usually the number one stock that Congress owns, so that's the one thing Apple has going for it. But I can tell you this, okay? The way people are starting to look at this is they're basically saying this is a tax on the internet, which always the goal was to not have the internet be taxed, right? And if you have a company that's basically collecting 30% fee every time somebody buys something on there, the way people are looking at that is it's basically this company is just collecting a 30% tax on the internet. So, nonetheless, we'll see how all that plays out. But it's just that Apple has a lot of fires to put out over the next year. It's obviously an ugly situation, and Wall Street's starting to wake up to this, right? Finally. Now, the good news is, if you want semiconductor stocks for cheaper, root for Apple to go down over the next year. Because the bottom line is when Apple goes down, it brings down all these semiconductor stocks. Cruzy Doozy, Micron, Skyworks, Qualcomm, Cuervo, Texas Instruments, Marvell. It brings all those babies down, right? And you see that on a day like today where Apple stock goes down, it brings down almost all those semiconductor stocks. If you want big tech stocks in general for cheaper, root for Apple to go down. If you want Amazon for cheaper, root for Apple to go down. If you want Tesla for cheaper, or Nvidia, or AMD, or Google, or any of these stocks for that matter, root for Apple to go down, because the fact of the matter is Apple is such a big weight on the market. When that baby goes down, it sends all these guys down as well. It can bring the whole indexes down, and it can bring all these other big tech stocks. So if you're looking to buy these other big techs, right, and you already like the valuations, you almost have to root for Apple to go down because it's going to likely bring down their valuations as well, right? It's very hard for, let's say, Google to go up if Apple's down 2%. Bottom line, if you were to tell me Apple stock goes down 30% over the next 3 months, I'm going to tell you there's probably a high probability Google's going to be down. I don't know about 30%, but it's going to be down at least 10 to 20% over that same amount of time. That's just the way it works, okay? If you want the entire S&P 500 for cheaper, root for Apple to go down. Here's the deal. Apple's 6.5% weight of the entire S&P 500. 6.5%. So when that baby goes down, it pulls the entire S&P 500 down. So if you were to tell me Apple goes down 30% over the next 3 months, 6 months, whatever, I'm telling you the S&P 500 is down immensely in that sort of situation. Immensely, right? If you want the Qs for cheaper, if you want the NASDAQ for cheaper, root for Apple to go down. Here's the deal. Of the NASDAQ 100, Apple has 13.2% weight. 13.2% weight. So if you want the NASDAQ for cheaper, root for Apple to go down because that baby carries weight. And bottom line is if Apple goes down in a major way, it's pulling down the whole index, right? Now, I think there's something that's very interesting here, okay? I think this would be very interesting if this happened. I think it'd be very interesting. So first off, Saudi, they're flying high right now because obviously oil's been in a fairly good place, and so they're making a ton of money right now, right? But I think it would be fascinating if Microsoft, good old Mr. Softy, actually passed Apple in terms of market cap. And I think that would be fascinating because it's a tale of two very different companies. And it's not just in terms of their business models, not just in terms of their management teams, but their approach to how they deal with competitors and partners. Whereas Apple has really, unfortunately, gone to the dark side over the past few years. And Apple's at war with everybody. Apple's at war with Google. They're at war with Meta. They're at war with, even Elon Musk and Tesla. They're at war with Spotify. They're at war with so many of the biggest companies in the world, right? And in a very negative way, versus a Microsoft that seems to play nice with almost everybody. Almost everybody Microsoft seems to play nice with. And I was even listening to the Adobe CEO talk, recently when they were doing the Figma acquisition, right? And Figma is starting to become a major competitor to good old Mr. Softy. And what you heard was a man that still spoke very highly about Microsoft, even though they're going to be potentially bigger competitors here in the future than maybe a lot of people thought, and talking about being a partner with them. So Satya Nadella has had a very good understanding of my opinion of making friends with everybody in the industry and not creating a bunch of enemies. And Apple's really gone the opposite route. And we're going to see how that's going to play out for Apple over the next few years. But I can tell you, a lot of people now are going to want to see Apple fail and going to want to see Apple start to deteriorate here because Apple's attacked them, because Apple's created problems for their business models in a major way. And there's definitely some smells of desperation coming from Apple. I was reading something recently, this is last week, that Apple even wants to start taking a cut of like boosted posts. So let's say you boost a post on Facebook or Instagram or wherever, right? Apple wants to take a 30% cut of even boosted posts. I'm like, how desperate is Apple getting for revenue now at this point in time that they're going to try to go after boosted posts? Like, this shouldn't even be like something that like is even in their consideration. They're going so far now at this point in time that it's starting to get scary. And it's like, what's going on here? Are you guys really that paranoid about your business model? Going into next year that you're going to start trying to take boosted post money? What in the world, man? That's absolutely insane, right? So Nonetheless, the market has a few problems we got to obviously work through here that are some pretty darn big ones. As far as tomorrow goes, we got Snowflake reports in Salesforce. Those are big ones. Those are very, very important stocks to the market. We're going to see what they report. And then Ulta just hit a new a new all-time high literally yesterday. And we'll see what they obviously report on Thursday. And also Kroger's a big one. Everybody's going to be looking at those inflation numbers and saying, what you got, Kroger? What are you going to tell us about inflation, baby? We want to hear about that. So hope you guys enjoyed today's video. As always, appreciate you joining me. Much love, and have a great day.